Most traders enter the market believing the central challenge is knowing when to act. Jesse Livermore believed the far greater challenge was knowing when not to. From the earliest days of his career, Livermore recognized a fundamental imbalance that most market participants never fully accept. The market is open nearly every day, but genuine opportunity is not. Prices change constantly. Yet meaningful situations, those offering clarity, alignment, and favorable odds, appear only occasionally. This mismatch creates pressure. When traders see constant movement, they begin to assume that constant participation is required. Livermore rejected that assumption outright. He believed that much of trading failure occurred before analysis was ever applied. At the moment the trader decided, they must be involved simply because the market was open. To Livermore, availability did not equal opportunity. In the bucket shops where he learned his craft, this truth revealed itself relentlessly. Traders crowded around the tape, watching every fluctuation with intensity. Each small movement felt like a signal. Each pause felt like delay. Stillness bred discomfort. Livermore watched these men closely. What he noticed was not laziness or ignorance. Most were alert, energetic, and engaged. The problem was that they treated motion as meaning. If price moved, they assumed action was required. If price stalled, they looked for reasons to force interpretation. Livermore observed a recurring and destructive pattern. The traders who were quickest to enter positions during unclear conditions were often the slowest to exit positions that were clearly wrong. They displayed impatience at entry and stubbornness at exit, a combination Livermore found devastating. This insight shaped his understanding of overtrading. He came to see that overtrading was rarely caused by flawed logic. It was caused by emotional discomfort with uncertainty. Traders were not reacting to market necessity. They were reacting to internal pressure. The need to feel engaged, productive, or justified pulled them into positions for which the market had offered no invitation. Livermore understood that the market does not provide clarity on demand, and any attempt to extract certainty prematurely usually resulted in loss. From this realization emerged one of Livermore's most underappreciated skills: the ability to remain inactive without anxiety. Waiting, for Livermore, was not passivity. It was observation under restraint. He believed that once a trader entered a position, objectivity began to erode. Commitment narrowed perception. Price movements were no longer interpreted neutrally. They were filtered through hope, fear, and bias. Staying out preserved clarity. Livermore became particularly cautious during periods of indecision. In such environments, traders were prone to illusion. They mistook noise for structure and coincidence for pattern. Mediocre conditions felt intolerable, tempting traders to downgrade their standards simply to participate. Livermore believed boredom was not a trivial inconvenience, but a genuine danger. In Reminiscences of a Stock Operator, patience is presented less as a virtue and more as a survival requirement. Losses incurred during low-quality market conditions did not merely reduce capital. They degraded judgment. Each unnecessary trade dulled sensitivity to risk. Each rationalization lowered the threshold for future mistakes. By the time genuine opportunity appeared, many traders were compromised, financially, emotionally, and mentally. Livermore learned to guard against this deterioration by refusing to engage during environments that lacked clarity. He did not measure productivity by activity. He measured it by discernment. If conditions did not align with his expectations of market behavior, the correct decision was inaction. This philosophy placed him at odds with traders who equated discipline with constant engagement. Livermore believed discipline began before the trade, at the point where a trader accepted uncertainty without attempting to escape it through action. He understood that the market would always offer stimulation. What it rarely offered was confirmation. One of Livermore's defining traits was his sensitivity to market character. He paid attention not only to direction, but to how prices behaved. Weak follow-through, erratic momentum, and inconsistent reactions all suggested conditions where probability was uncertain and risk poorly compensated. During such periods, Livermore stayed out. He described times when he observed the market for days or weeks without committing capital. This was not hesitation. It was selective engagement. Observation allowed him to refine expectations and avoid premature conclusions. Livermore believed that readiness mattered more than presence. He was equally cautious following large emotional moves. He understood that markets often required time to digest extremes. Traders who rushed in immediately after dramatic advances or declines were often reacting to emotion rather than structure. Waiting was a form of timing, not avoidance. Livermore also recognized that sometimes the most dangerous variable was not the market, but the trader. Emotional imbalance, fatigue, frustration, overconfidence, distorted judgment silently. He observed that traders frequently blamed the market for losses that originated internally. If clarity was absent, trading should stop. This philosophy required honesty. It demanded that a trader acknowledge that not every day held opportunity, and not every session required participation. Livermore believed consistency of behavior was far more important than consistency of activity. Markets reward preparedness, not persistence. Over time, Livermore came to view selective participation as a form of leverage. By preserving mental clarity and financial capital during unfavorable conditions, he ensured the capacity to act decisively when opportunity finally aligned. He often noted that missing a trade was rarely catastrophic. Participating in the wrong one often was. The market, in his view, would always offer another opportunity. What it would not always offer was the clarity or capital required to take advantage of it. Protecting both demanded restraint. Knowing when not to trade became one of Livermore's defining advantages. It was not visible on a chart. It produced no dramatic stories. And it offered nothing to boast about, which is precisely why most traders ignored it. Yet it allowed him to endure long enough and remain composed enough to profit when conditions finally favored action. For the modern trader, the lesson remains unchanged. Not trading is not failure. Waiting is not weakness. Inaction is not avoidance. Often, it is discipline in its most refined and demanding form. Livermore understood that once a trader mastered the ability to avoid poor conditions, favorable conditions required far less effort. That is why knowing when not to trade was not a limitation for Jesse Livermore. It was one of his greatest protections.